Recording in progress.
So go to chapter 25 in business, statement of financial position. When we talk about statement of financial position, we're talking about a statement that talks about the value, the worth of a business. For the income statement, it talks about income and expenditure. But for the statement of financial position, it helps us to know the worth or the value of a business. So we scroll down. In the previous chapter, we learned how a manager can calculate whether the business is making a profit or loss, which is through the income statement. However, business owners would be very interested to know how much their business is worth. This information, together with other details, is given on the statement of financial position. So if you want to know the worth of your business as an owner of a business, you know through the statement of financial position. The statement of financial position is very different from the income statement. The income statement records the income and expenses of a business and the profit or loss it makes over a period of time, usually 1 year. The statement of financial position records the value or worth of a business at just one moment in time, usually at the end of the financial year. So a personal statement of financial position example will help to introduce the basic concept of this account. So there's a case study here. We have house, car, savings, bank loan. All these are items owned by Sanchez, all debts owned by Sanchez. So whatever the business has that belongs to the business, they are all assets. And whatever the business owns that owes to third party, they are liabilities, they are debts. So that's about that. So what are assets? Assets are those items of value which are owned by the business. So land, building, equipment, vehicle are part of non-current assets, which they stay more than a year within the business and they are owned by the business. And we call them fixed assets too. Fixed asset or non-current assets. Then we have the current assets, which are, so before they said, there are intangible assets that are those that do not exist physically but still have a value. So for intangible assets, they are not physical, like the brand name, the patents, the copyrights, but they have value. They add value to the business. They add value to the business and to the goodwill of the business. So cash, inventories, stocks, accounts receivable, that's your debtors, are only held for short periods of time and they are considered as current assets. So for current assets, these resources stays with the business for a short period of time, less than a year. That's different between non-current asset and current asset. Then we go to liabilities. We call them liabilities because these items are owed by the business. So you are owing some people, either long-term, which is non-current liability, or short-term, which is current liabilities. So for long-term, you have the opportunity to pay for more than a year. And for short-term, which are current liabilities, you have to pay it within a year. Example of short-term is your suppliers, your credit suppliers, your other receivable, other payables. And for long-term, we're talking about a long-term loan like debenture. I think it's clear. So then we have what we call owner's equity, which is total assets minus total liability. So our capital or total equity or shareholder funds is total assets minus total liabilities. Your total assets is current asset plus non-current assets. Then total liability is non-current liabilities plus total current liabilities. I think that is clear. We move down. Then the explanation of the statement of financial position, which I think I did already. Okay, total asset less total liability is our net. We call it fund. Okay, we talked about that, which is capital. Shareholders' equity, the total sum of money invested into the business by the owners of the company. So the total amount of money invested by shareholders is called the total equity. I think it's clear. So this money is invested in two ways. One, either by share capital, which is the money put into the business when the shareholders bought newly issued. That's when there's issued share. When they are issued shares, we call it share capital. Then if profit or loss is being made by the business and it's being put back into the business, that's retained earnings. We call it reserves. So both of them brings additional capital into the business. I think it's clear. But for share capital, you have to pay dividends to shareholders. I think you know that. Okay. So we scroll down. Then we have examples of non-current assets, examples of current assets, liabilities. Short-term liabilities or current liabilities, we have creditors and bank overdraft. For long-term, we have long-term bank loan, which debenture is also an example. And for our shareholders' equity, share capital plus, you add it with your profit and loss account reserves. So that's our funds, our equity. I think, do you have any other thing about that? Interpretation of the statement of financial position data. So it says shareholders can see if they're okay. So for the statement of financial position, what does it even really help to do? One, it allows shareholders to know if their stakes have increased or reduce over a period of time. That means the value, if the value of asset is increasing, that means your stake is increasing. Stake, that means your business, your stock is increasing or decreasing over a period of time. That's the first thing. 2, shareholders can also analyze how expansion by the business has been paid for by increasing non. So you want to know, through your statement of financial position, you would know if your expansion, maybe you expanded your business, if the growth of the business is being sponsored through liabilities or through share. You'll be able to know that. That's what they said, by increasing non-current liabilities such as long-term loans. So you might expand your business through loans. You might have expanded your business through selling more shares, issued share. You would be able to know based on the value on your current liability, on your liabilities or your assets. Yes. Working capital can be calculated, and for working capital, it is always current asset minus current liabilities. I think you know that already. So no business can survive without working capital. It is used to pay for short-term debts. If these debts cannot be paid because the business does not have enough working capital, the creditors could force the business to stop trading. Capital employed can also be calculated by using the data from the statement. Okay, so the difference between capital employed and working capital is that for working capital, it's your current assets minus your current liability. But for capital employed, that means you're talking about the money put into the business. It can be shareholders' fund plus non-current liabilities. Those are the two ways in which you can put more capital into the business. Capital employed, either through shares and if there are loans you've taken from banks, you add it. So that gives you your capital employed. Okay. The difference between them, I think you understand. Capital employed is shareholders' fund. That's shareholder fund plus non-current liabilities like loan. For working capital, it is your current asset minus your current liability. I think it's clear. Yes. So what else do we have there? Does that end the chapter? Yeah. Okay, that ends the chapter. Are we sure? Okay, that ends the chapter of statement of financial position.